Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Mortgage-Backed Securities Explained, a guide for investors and finance enthusiasts. Freddie Mac, Federal Home Loan Mortgage Corporation, similar to Fannie Mae, Freddie Mac purchases and bundles mortgages, then turns them into securities. It primarily works with smaller financial institutions like savings banks. Freddie Mac's role complements Fannie Mae, together covering a wide range of lenders. Ginnie Mae, Government National Mortgage Association. Unlike Fannie Mae and Freddie Mac, Ginnie Mae doesn't buy or sell loans. Instead, it guarantees MBS made from loans backed by federal agencies like FHA or VA. This guarantee ensures investors get paid even if some borrowers default, making Ginnie Mae-backed MBS highly secure. These entities provide confidence to both lenders and investors. Their involvement helps stabilize the mortgage market, ensuring continued access to affordable home loans while protecting investors from major losses. By combining the mortgage origination process with support from government entities, the MBS market remains liquid and resilient. This system creates a win-win scenario. Lenders gain cash to issue more loans, and investors get a predictable income stream tied to the American housing market. Benefits of investing in MBS. Mortgage-backed securities, MBS, offer a unique mix of opportunities that appeal to a range of investors. Whether you're looking for steady income or ways to balance your portfolio, MBS can serve as a valuable addition. Here's why they matter and how they might work for you. Income generation. MBS are popular for their ability to deliver a steady income stream. Here's how. Homeowners pay their mortgage bills every month, and with MBS, those payments are passed on to investors. This includes both interest and, in some cases, a portion of the principal. The result? Regular cash flow, similar to earning rent on a property but without having to deal with tenants or upkeep. For most investors, this reliable income can be a cornerstone of their portfolio. It's especially appealing for retirees or those seeking predictable returns. Unlike stocks with price fluctuations, MBS income depends on the regularity of mortgage payments, which tend to be stable. Consider it a paycheck when the markets get shaky. If you're looking for ongoing returns without constantly chasing performance, MBS could tick that box. Diversification benefits. Diversification helps reduce risk, and MBS provide a unique way to spread yours. How? By offering exposure to the housing market while being tied to the broader fixed income space. Here's why that matters. Low correlation with stocks. MBS don't always move in lockstep with the stock market. When equities hit turbulence, MBS might hold steady, giving your portfolio a cushion. Broad investment mix. Investing only in stocks or bonds limits your options. MBS diversify your income with assets tied to real estate, which behaves differently than traditional investments. Risk flexibility. MBS allow investors to choose their comfort level. Opt for safer tranches if you want stability or higher risk, higher return slices if you're prepared for uncertainty. Think of MBS as a financial middle ground. They hold elements of both real estate and bonds, offering balance when markets zig and zag. For investors seeking stability and variety, adding MBS can enhance both. Whether you're interested in long-term income or want additional balance in your portfolio, MBS have plenty to offer. Each benefit ties directly to investors' common goals: financial security, steady returns, and reduced risk. Risks associated with mortgage-backed securities. Investing in mortgage-backed securities, MBS, isn't without risk. While they offer income opportunities and diversification benefits, they also come with challenges that can impact returns. Understanding these risks helps you make smarter investment decisions. Prepayment risk. Prepayment risk occurs when borrowers pay off their mortgages earlier than expected. This happens when homeowners refinance their loans, sell their homes, or make large extra payments. For MBS investors, this can lead to lower returns. Here's why. When borrowers prepay, the principal of the loan is returned early. Investors then lose out on future interest income. Prepayments often occur during periods of falling interest rates. This reduces the chance to reinvest the returned principal at similar or higher rates, shrinking future earnings. Think of this risk like planning for steady rainfall only to face a sudden drought. Prepayments reduce the consistent income stream you might expect from an MBS. It's a downside that requires careful consideration, especially in changing interest rate environments. Credit risk. Credit risk is tied to the possibility of borrowers defaulting on their mortgages. If borrowers fail to make payments, the MBS might underperform or lose value. Here's how credit risk can affect your investment. Defaults lower the income generated from the underlying loan pool in the MBS. Some MBS are backed by government guarantees, like Ginnie Mae, reducing credit risk. Others, particularly private label MBS, don't have this backing and carry higher risk. For example, during the 2008 financial crisis, rising defaults wreaked havoc on MBS. Even though safeguards like tranches exist, higher risk layers took significant losses. When weighing an MBS investment, paying attention to credit ratings and borrower quality is critical. It's like sizing up a foundation before building a house, stability matters. Market risk. MBS prices can also fluctuate due to changes in the broader market. This is referred to as market risk, and it's influenced by factors like interest rate movements and economic conditions. Here's how it works. Interest rates. When interest rates rise, MBS prices typically fall. This is because new securities with higher yields become more attractive, reducing demand for older ones. Economic shifts. If the economy takes a downturn, borrowers may become less likely to pay their mortgages, increasing default rates. Imagine owning a ship at sea. Calm waters, stable interest rates, make the journey smooth. But if a storm brews, interest rate spikes, the value of your ship drops, creating an uneven ride. Market risk makes it important to regularly review your investment and its sensitivity to financial conditions. Balancing MBS with other investments can help reduce overall exposure. By understanding these risks, prepayment, credit, and market, you can better prepare for the challenges MBS investments bring. These risks don't make MBS a bad choice, they just require thoughtful analysis, planning, and an awareness of your own financial goals. The role of MBS in the financial crisis. Mortgage-backed securities, MBS, became infamous during the 2007-2008 financial crisis. While they were designed to spread risk and create liquidity, their misuse and complexity sparked a chain reaction that led to one of the worst economic disasters in modern history. The subprime mortgage crisis. At the core of the financial crisis was the explosion of subprime mortgages, loans issued to borrowers with lower credit scores. These risky loans were bundled into MBS and sold to investors. The idea was that pooling these loans would reduce individual risk. But in reality, this strategy backfired. Why? Many subprime borrowers couldn't keep up with payments. Their loans were often based on teaser rates, low initial interest rates that skyrocketed after a few years. When the rates adjusted upward, homeowners defaulted in droves. Here's what happened next. High default rates. As borrowers stopped making payments, the value of MBS tied to these loans plummeted. Investors who relied on these securities for steady income suddenly faced massive losses. Overconfidence in ratings. Credit rating agencies had graded many MBS as safe investments, even those packed with risky subprime loans. Investors trusted these ratings blindly, not realizing the true risk they had taken on. Ripple effect. Banks and financial institutions had loaded up on MBS, especially risky tranches offering high returns. When defaults spiked, their balance sheets took a massive hit, leading to widespread instability. It was like a house of cards collapsing. Subprime mortgages were the weakest link, but their failure spread across institutions holding MBS, dragging down the global economy. Aftermath and regulatory changes. Once the dust settled, it became clear that financial systems needed stricter oversight. The crisis exposed glaring issues in how MBS were created, rated, and sold. Regulators took steps to prevent a repeat of this disaster and restore trust in the markets. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.